This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in chapters 4 and 5, we learned how to establish the tax-adjusted trading profit of any given accounting period. That would be done based on taking the net profit as per the statement of profit or loss, adding back firstly any non-allowable expenses and deducting any income that was not trading, and then in replacement of the disallowed depreciation charge, we computed and deducted capital allowances. And that gave us a tax-adjusted trading profit for a given accounting period. But of course, we need to then include a figure of profit for that trade on each relevant income tax year's income tax computation. And so we learnt in chapter 6 the basis periods, the way from the very first tax year in which we start to trade, all the way through to, if necessary, the very final tax year in which we cease to trade. How it is we are able to establish the figure of profit to then be assessed for any given tax year. We looked at our bases of assessments, establishing our basis periods for each tax year, and then established the profit figure to include within the relevant income tax computation for the relevant tax year. But all the time we were doing that, there was a single outcome, that the result for any adjustment of profit and computation of deduction of capital allowances was always profit. Sadly, real life isn't always like that. And once we've done our calculation of the tax-adjusted trading profit, after computing and deducting there, as we just said, the capital allowances figure for that accounting period, once we get that outcome, sadly, it's not a profit. It is instead a tax-adjusted trading loss. So it's here now in chapter 7 where we deal with unincorporated traders, i.e. individuals here, and we establish for that individual, firstly, what tax-adjusted trading loss has arisen, same as you did in chapters 4 and 5, adjustment of profits. You might even be starting with a profit. It doesn't have to be starting with a loss. The adjustment process and the computation and deduction of capital allowances may lead you to a tax-adjusted trading loss figure. But you do your adjustment of profit or loss based on the statement of profit or loss, compute and deduct capital allowances, and you get a figure of loss. What does that mean, therefore, and how do we then give relief for that loss? Because one thing is for sure, if HMRC are going to assess us and charge us to tax on profits, then they have to, and they do, give us relief for tax-adjusted trading losses that we then sustain. Now, first of all, again, we need to know if we have a loss underpinning the basis period and the basis of assessment for the tax year, then what do we include on the income tax computation? Well, if the figure is a loss, if the basis period for a tax year has a trading loss, then very simply, the trading profit assessment to include in the income tax computation is nil. So we never include a bracketed, a negative figure, a loss figure on the face of the income tax computation. The trading profit figure in an income tax computation can never be a negative. If there's a loss, then it is a nil assessment. So if, for example, the business had always prepared its accounts to the year ended the 31st of December, and for the year ended 31st of December, the business made a loss of £40,000. First thing we'd have done, of course, was to establish that tax-adjusted trading loss using the adjustment of profits, using the capital allowances knowledge that we have got. And because this is another routine accounting year, we would now establish, well, in which tax year will that be assessed? For a normal ongoing business such as this, we use CYB. Oops, got an I in there for some reason. We use CYB. Now, the year ended 31st of December 20, in which tax year does that end? 31st of December 20 falls in the 2021 tax year. And in that 2021 tax year, we will therefore have to include on the income tax computation an assessment of nil. So in the income tax computation, For 2021, trading income figure shown nil. We do not put a loss of 40,000. But instead, we then look at the options that are available to use that loss of 40,000. Obviously, we've had income of the business that's been, when it was profitable, assessed, and in the future there will be assessable income. No doubt we'll turn it from loss-making back into the profit-making machine that up until now it has been. And we may have other income, of course, in any of these tax years. So when you look at a loss that we now know to be £40,000 and is assessed in and gives the nil assessment in 2021, we'll refer to the current tax year, the tax year of loss, being now here for us 2021. And we've got to look at what we can do with that. Now, we're dealing with losses, at least for a basic continuing business, rather than one that has just started or one that has just ended. For a normal continuing business, there's basically either of three things we can do with a loss as regards where we may be able to use it. As we've just said, for the income tax computation for 2021, we've got a nil assessment. But we may have other income that is chargeable to tax. We could have property income. We could have savings income. We could have dividend income. So we may have a figure of income that would be chargeable to tax in the current tax year. And of course, in the preceding tax year, there was no doubt a figure of income, a taxable income figure chargeable to tax. And in the future, let's hope it's a one-off loss-making period, we would return to profitable ways. So basically, when you're dealing with losses, the loss reliefs that are available will effectively enable you to do one or a combination of up to three things in terms of where you can take the loss. First of all, what we could do is to look to use that loss in the current tax year. There will be other income, as we've said, be it property income, interest income, their dividend income. We may even possibly have a little sideline employment as well as self-employment. There's no end of sources, therefore, of other amounts of taxable income. So we could use the loss in the current tax year. And if we don't use it in the current tax year, or we choose not to use it in the current tax year, then there's either of two directions that we can go. We can either carry that loss back to an earlier tax year, which in most circumstances, as we'll see certainly in this lecture anyway, is the preceding tax year. And if we've done that, or we choose not to do that, if you've relieved in the current tax year and or in the preceding tax year, then there's only one other direction you can go, and that, of course, is forward. So we can use the loss in the current tax year, in the preceding tax year, in a future tax year. So the only question, therefore, is when we use the losses in those tax years, what do we put the loss against? What figure of income do we put the loss against? And as we'll discover in our notes in a moment, the way that we relieve that loss will be to enable us, if we wish, to use it in the current tax year and or the preceding tax year against our figure of total income. Or if we carry it forward against only one figure of income, the future trading income of that trade. Now then, we have seen this before. Don't expect you'll remember this, but way back in our very first lecture in relation to our income tax computation, we saw on the first page of those notes in chapter 2, you can look back to it now, you will have seen there the introduction, though it wasn't relevant then, of loss reliefs onto that income tax computation. Now, let's see if I can find those for you now. Pardon me while I wind all of this back. And we'll find for chapter 2. Here we go. There's that pro forma income tax computation. There on, where are we, page, won't be a very big number, On page 5 indeed. And what we did, we focused, of course, our attention on the different types of taxable income that we would have. And we used our columnar format, something I hope that you're particularly familiar with and easy with now. So our non-savings, our savings and our dividend income in that order. We listed out the sources of taxable income. Earned income could be either trading and or employment. Then we had different sources of investment income. That could be rental income from properties, it could be dividends, or a variety of different sources of interest there. And that brought us to total income. And then there were deductions from total income in deriving net income, then the personal allowance deducted again to get you down to taxable income. And those deductions that feature on the face of that computation included losses. And look at what we had. The very first one that we see here was to deduct directly from a trading profit assessed in this tax year any trading loss relief that was brought forward. So there was one of the reliefs that I just mentioned, and I'll go back to the losses chapter in a moment and show you the detailed note on that. But one of the possibilities was to carry forward to the future. And if you carry forward to a future tax year, then there is only one figure of income against that which that loss will go. And if you do carry forward, it must go against the next available future trading income of the same trade. It will go directly against that trading profit. So there we go. There's one of the loss reliefs we'll need to come to know and love, the carry forward of a loss from the tax year in which the loss was made, carried forward to set off against future trading profits of the same trade. But only trading income, and that's why it's up there, directly deducted from trading profit. But then there are down here other trading loss reliefs that allow you to set off against total income. Against total income. Now, what have we said? If we make a loss in the current tax year, we have a nil assessment. If you chose, as you'd be free to choose, just to carry all of that loss forward, then it would go against the next available future trading income, only the trading income. But if you wanted to, as certainly in any exam question you will be wanted to use that loss sooner rather than later, then we have the current tax year and or the preceding tax year. That's where this deduction from total income applies. If we were dealing here with a current tax year claim, then that would be against total income. Against total income, as we see there, there is our deduction against total income. And as with all of these deductions that apply against total income, then there is an order in which we deduct. And that order is the same order as which we lay out our computation, where we go from non-savings to savings and finally to dividend income there. So if you are using a current year loss, you go against the total income of the current tax year. And when you make these claims, as we said a moment ago, in terms of a carry forward claim, only with the carry forward, you had no choice. It will go against the next available future trading profits. Here for the current tax year, the preceding tax year, you can choose to claim or not to claim for either or both of those tax years. It's up to you to make that call. But if you do make the claim, then as we'll see in the detailed notes, it goes against all of the total income. You can't make partial claims here. It goes against all of the total income. Now, from a planning perspective, let's think about the benefit of using the loss, say, on a carry back basis rather than a carry forward basis. If you carry forward, then there's no immediate relief for the loss that you have sustained. You have to wait until there's a future trading profit and then wait effectively to the date at which you would have paid the on that future profit before you get any cash flow benefit out of the use of that loss. It reduces a future profit, it reduces a future taxable income. When would the tax have been payable on that future taxable income? It would be payable sometime even after the end of that tax year in which we've used it, basically a long time from now, more of the detail later. And that means you get no immediate relief for the loss. Whereas, if you carried back the loss to the preceding tax year, then by the time you've established your computation for this year, any tax that would have been payable for the preceding tax year would by now have been paid. So if you are now able, as you are, to take that current year loss and set it off against the total income of the preceding tax year, then that allows income that was charged to tax for the preceding year and which tax charge we have by now already paid. We can remove some or all of that income depending on how much loss there is, how much total income there is. Remember, we can't make a partial claim, but we will set all of that loss available against all of that total income. That may remove just some of the total income, it may remove all of the total income. But what it will mean is that if the income goes down, the figure of tax goes down. Indeed, it may go down to zero. We've already paid the tax for the preceding tax year, so look what happens in terms of cash flow. You put your preceding tax year claim in, it takes out the income, or some or all of it anyway, for the preceding year. You've already paid the tax on the original figure of income that you had for that year, so you've overpaid the tax. You will get a repayment of that tax from HMRC. Now, in cash flow terms, it doesn't get any better than an immediate repayment of tax that you had previously paid. So there's a big advantage for a carry back relief as compared to a carry forward relief. Carry back, as soon as the loss relief claim is agreed by HMRC, you'll get your repayment of last year's tax. If you carry forward, it will reduce a future trading income figure. The earliest that could be is the next tax year, and you'd only gain any cash flow benefit from it when the tax for that tax year would otherwise have been paid. That's something in terms of administration that's in Chapter 15, but we'll make brief mention of that a little bit later within this chapter when we deal with these detailed reliefs. So it's important for you to know where these loss reliefs will feature on an income tax computation. If the loss is being carried forward, then it will be up here against trading profit. If, on the other hand, you are using the loss in the current tax year and or the preceding year, it goes against that figure of total income. This is where the loss relief comes in. Now, what we can see is, in cash flow terms, from a planning perspective, it was a very good idea to be able to carry back a loss to go against the total income of the preceding tax year rather than carry it forward to a future tax year. But if you go forward to a future tax year, it only goes against trading profit there, just one thing. Now, that may be seen to begin with to be bad news because that still leaves lots of other income still to be charged to tax potentially. But the snag about the more generous reliefs against total income in the current tax year, in the preceding tax year, is that they go against total income. They don't go against taxable income. They go against total income. And that therefore may mean that it leaves, I'm going to give it scribbly down here, isn't it? As that loss relief has gone against total income, it will therefore have reduced the net income. It may even have eliminated that net income. And that means that that personal allowance may be either entirely wasted, unused, or partially wasted, partially unused. And what you'll have done is to use a loss relief that may have had alternative options for its use. You've used a loss relief to to go against income, some part of which wouldn't have been taxed anyway, because it would have been covered by your personal allowance. And therein lies the problem of the current and carryback claims. They go against total income if the loss is bigger than the total income. All the total income goes, and then there's absolutely nothing to deduct the personal allowance from. So you've wasted the personal allowance. And if you waste the personal allowance, the clue's in the word waste there, it is wasted. Because if you don't use it this tax year, you're not going to be able to use it in any other tax year. With personal allowances, it is that use it or lose it idea. If there's no income to put the personal allowance of this year against, then too bad, you didn't need it, and next year you'll get another personal allowance to put against next year's income. But you don't get to carry it forward. If you don't use the personal allowance, it is lost, and that's it. So we can see here some planning objectives already starting to come into play. Although we've not yet got to grips with the detail of these loss reliefs, and don't panic, I'm going to take you through that with examples very soon. We've now got the basic idea. So what I'd like you to do is just pause for one moment here and just go back and think about what I've just said in terms of if there is an accounting period of loss, we use our basis period rules from section 6 to establish when that basis period would be assessed. We never put in a loss figure, we put in a nil assessment for that year. And we then separately consider, so what can we now do with that amount of loss? And what we saw was we could relieve it in the current tax year and or in the preceding tax year against total income. And or we could be carrying forward, but only to go against future trading profits of the same trade. What will guide us as regards getting the best use out of that loss, as we've just said, it would be nice to be able to gain immediate use of that loss. A repayment of tax is better than a future reduction in tax. But if we do go with the more immediate claims, they're against total income, and what that will mean is we may, depends on how much loss and how much total income, we may end up wasting the personal allowance, and that means that a loss effectively will have been wasted because it's gone against income, a figure of total income, that if we'd left some or all of it still in charge to tax, we wouldn't actually have paid any tax on it anyway, because we had a £12,500 personal allowance to deduct from that figure. Okay, just have a think about that for one moment, and I'll take us back to our Chapter 7 notes, and we'll have a look at the detail thereon. So pause for a moment. Okay, so back to our notes in Chapter 7, therefore, whereas we'd scribbled in here on this opening page, we saw that if we made a loss of tax-adjusted trading loss of £40,000 for that there year-ended December 20, that accounting period using CYB was assessable in the 2021 tax year. We would have a nil assessment for that tax year. So your current tax year here, 2021, the one in which the loss has arisen. So what now are the options given what we have just detailed? What we could do is to set off against, if there is any total income of the current tax year. So a current year claim would be 2021. We may prefer, given what we've just said about gaining a cash flow advantage, to carry back that loss to use against the total income of the preceding tax year. Well, if the current year is 2021, the preceding tax year was 1920. Again, what do we go against? Total income. Again, both current and preceding year claims against total income, no partial claims are allowed. And what that means is, if we were to make those claims and the loss was bigger than the figure of total income, that would bring down your income to zero and it would waste your personal allowance. If the loss claim reduced the income below the level of your personal allowance, for 2021, of course, that being 12,500, then at least some of that personal allowance would have been wasted there. Other than a current and or preceding year claim against total income, the only other thing to do was to carry it forward. Well, if this current tax year, as we've seen there, is 2021, the earliest it could be used is 21-22 and would be used on a carry forward against any figure of trading income that arose for assessment in that 21-22 tax year. It goes against the next available future trading profits of the same trade, as we will see. That, of course, limits the use of the loss. It only goes against trading income instead of total income, but that may be a good idea if it then meant that it left other income for that tax year, apparently still assessable, which doesn't sound like a good idea, but if the amounts of other income do not exceed the level of the personal allowance, then of course we have been able to save some of the loss that we've carried forward to go against, again, a future figure of trading income while still paying little or no tax for this period because the other income is covered by the personal allowance of the year. Okay. Let's just recap the technical points with these notes now. Again, we need to follow the rules. A repayment of income tax may result in some circumstances. That is basically when you carry the loss back to the preceding tax year. The reliefs available. Now, there are two main reliefs that exist for continuing businesses. The carry forward, as we've just said, against future trading profits of the same trade. Again, no partial claims in the future will go against the next available future trading profit of the same trade. If you want your relief more quickly than that, it goes against total income, and that can be of the current and or the preceding tax year. Flexibility there in terms of what you choose to claim, but once you choose a tax year in which to claim it, be it the current, be it the preceding year first, whichever one you choose, then it will go against all of that total income. Again, no partial claims. Now, other than that, there are three other reliefs that we'll need to be familiar with. I'll only briefly mention them now. We've got enough to be thinking about with those current year carry back, carry forward claims there. But if you were to have made a claim in B, so against either the total income of the current tax year or the preceding tax year, if you've made that claim and there was still an amount of loss left over, then for that tax year, the one in which you have made that claim, and there is still loss left over, you can now change the nature of that loss. You've used a trading loss, which is in income tax, against income. But what you can now do is to extend that claim with the remaining loss figure and put it against something we don't know much about at the moment, but the capital gains of that tax year. You can effectively turn what was a trading loss into a capital loss. And that's this one. Following a claim in B, if any trading loss still remains, the taxpayer may choose to extend the loss claim. It's up to you. You don't have to do this, but it becomes available, but only becomes available for that tax year, be it the current or be it the preceding tax year, if for that tax year you have firstly made the claim against total income and there is still some loss left over. It is that loss that may then be used against your capital gains, turning a trading loss effectively into a capital loss. Extend the loss claim against the chargeable gains of that tax year. Other than that loss relief, which is available from the very first tax year to the very final tax year, alongside the first two reliefs, the carry forward and the carry back options there, we then have two specialist reliefs that we'll see at the end of this chapter that deal with, firstly, a specialist relief, which is an opening year's loss relief, which will allow like current and preceding year claims to go against total income. So it's just the same. But what makes this one better than just the current year and the preceding year, with your normal claim here, that one, for the ongoing business, the furthest you can carry back the loss is to the preceding tax year. But look what can happen here. You can go back against the total income of the preceding 3 tax years. Now, for which tax years this specialist opening years relief is available, that's for later, that's for the detail. But you'll get the idea here that you would, if you made a loss early on, maybe in the first period in which you traded, that would allow you to carry that loss back up to 3 years there, and we could go back 3 years, again back to a date where we hadn't even started to trade. Maybe before we'd even thought about setting up a trade there. We can go further back. Now, if you can go back 3 years, which you can with this relief, that means you could go against income not just of one of those 3 years, but it would be against all of those 3 years on a first in, first out, going to the earliest year first. And that means you could take out income of up to 1, 2, or 3 of those preceding years. And the downside of this is you'd have made a blooming great loss if this was able to go back that far. But it does give the opportunity for the taxpayer who started to trade, but unfortunately early on has made losses in that trade, to be able to get more immediate relief for that loss, getting a repayment, which might be just the cash flow impetus that it needs, maybe to keep that particular trade going there, by carrying back the loss 3 years and gaining repayments of even earlier tax years. More of that later. And finally, very appropriately, finally indeed, in terms of this chapter, we look at terminal loss relief. And that, of course, means we're dealing with cessation of trading. Now, if you cease trading, your unincorporated business ceases. Clearly, there is no longer the option to carry forward because the trade has ceased. There's no future trading profit. So what do? They allow you again a better opportunity to immediately use that loss by carrying it back further than the normal 1 year carry back would allow. But this is very specialist. It is allowing, again, like with opening years, a carry back against the previous 3 years there, but only the previous 3 years trading profit. You've ceased to trade, you can't carry forward against future trading profits because there aren't any, so they allow you to go back against the previous 3 years worth of trading profits. What, of course, you'll have to do is to weigh that up as another option, as with the opening years, another option compared to the normal loss reliefs that are available. But for the moment, in terms of this particular session anyway, we are just looking at the first 2 of these reliefs, the carry forward relief and the current tax year relief and preceding year relief in terms of current, carry back, carry forward. The simplest of them all is the carry forward of trading losses, and that is where, as we know, it may be carried forward and set against the first future trading profits that arise from the same trade. You don't have the option on this that next year, well, we make a little bit of trading profit, and it's so little, I won't bother this year. You will bother. When it goes forward, it will go against all of the next available future trading profits until such time that that loss has been used. The trading losses we just said there must be set off in full against the next available trading profits. Any loss remaining is carried forward until further profits arise. The loss may be carried forward indefinitely, of course, until such time that the trade ceases to trade there. There's nothing else that you can do after that. Example 1, nice little simple example there in terms of calculate his assessable amounts for all relevant tax years. And what you have here is Albert has the following recent trading results as adjusted for tax. This is a normal continuing business that has been preparing accounts to the 31st of December in each year. And for the year to 31st of December 19, right, using CYB, in which tax year will those profits be assessed? If there were profits, the basis period year in December 19, that will be 1920. The problem is it's not a profit, it is a loss. That means that there is a nil assessment in the income tax computation for the 2019-20 tax year, and we then need to consider what could be done with it. Here, if we're purely looking at the one option, the carry forward, it goes forward against the next available future trading profit. Well, there, year to 31st of December 2020 there, that would have been assessed in 2021. We have a profit of £3,000. If you choose to carry it forward, there is then no choice over how it is used. That 5,000 would go against all of that 3,000, and that would therefore take out all of the 3,000. That would use 3 out of the 5, leaving you 2,000 to go forward again against the profit of the year to December 21, assessable of course there in 21-22. We've used 3 of the 5,000, that means we've got 2,000 left, and that 2,000 would go against that £10,000 there. Well, although you probably don't need it, let's just have a little look at the suggested solution, the model answer to this, so to speak, just to show you a few issues about presentation and about workings here. Now, with this example, it was simple enough. We had 3 tax years. In the first of those tax years, the loss was sustained, and it was purely about one thing, the carry forward against future trading profits. In an exam question, what you're far more likely to see is still 3 tax years, but the loss making, the current tax year in terms of our use of loss reliefs, is likely to be the middle one. And what you've got is the ability then to demonstrate your awareness of all of these ongoing loss reliefs. So what you would have is the potential to claim against total income in that the current tax year. You could do that and then carry back, or instead carry back, against the preceding tax year, and again those claims against total income. Here there was just one figure of income, trading income, and the first tax year was the loss-making year. It was just carry forward. As I say, in a more exam-like question, it's going to be mixing the current year, the carry back and the carry forward reliefs, and potentially the Section C question, discussing those options as well and identifying the reasons for pursuing one particular alternative over another. In terms of just this exercise, which could have been the basis of an objective testing question, then workings don't matter. But they do matter in terms of an answer to a Section C question. And what we're going to see in our next session together is when we start to combine these different loss reliefs, then our answer presentation, our workings, are going to be twofold. We're going to have, yet again, as we've seen here, columns for each tax year relevant. Typically, it's 3, current tax year, preceding tax year, and then the future, the next tax year. We will establish a trading income figure to go into each of these tax years, knowing, of course, that where there is a loss, it is a nil assessment. Whatever the loss is then goes in to a working entitled the loss memorandum, and we record that trading loss figure. And we'll then identify the possible uses of that. In a bigger question, there is or will be more sources of income than just the trading income. So we'll have a trading income figure, a gap after that into which the carry forward relief can go, such as we've seen here and here, because the carry forward can only go against trading income, will only go against trading income. Because remember, once you've chosen to carry forward, then you have no choice thereafter. It will go against the next available future trading profits of the same trade in full. But then if there's other sources of income, you would list out those other sources of income and get a figure of total income. Again, after that, you'd leave a gap before showing any deduction of the personal allowance and before deriving what is still to be the net income figure. And that's where your two more immediate reliefs, the current year relief and the carry back relief to the preceding tax year, that is where they will go, such as we'll identify indeed next time in an answer to an example I'll take you through. So get used to the idea that you're going to have columnar workings for the relevant tax years, typically 3. If we do get in one of those specialist situations of opening years or closing years, where you may have a carryback that extends over a period of 3 years, then you may need even more columns. Indeed, you will need even more columns there. But this is typically the ongoing example, where 3 tax years, current, carry back, carry forward, all of those issues, those years are then covered. In terms of columnar working, trading income, leave a gap for a brought forward trading loss relief. Other sources of income down to total income, leave a gap in which your current year relief and your carry back relief can then go into before defining net income, deducting your personal allowance and getting your bottom line figure of taxable income there. Okay, so the 2 main parts, columnar working for all the numbers that go into your problem and a loss memorandum to show clearly what has happened to it. Again, on a section A or section B, it's more likely to be a section A question here, objective testing question, then presentation of workings are irrelevant. You either get the right letter or you don't. So you've just got to go about getting your answer as quickly, as easily as you can. But if it is section C, as well it may be, then you do need to think about your presentation of your workings, just in case numbers are, again, you make the odd error, be known in the exam, you may recollect that yourself. So in which case, identify where your numbers have come from and how you've dealt with them, so that marks can be awarded for what you do, and you are marked positively for what you've done, rather than negatively for what you haven't done there. But we have to see what your process is, what your approach is. And those would be your workings. Okay. Between now and next time, again, obviously, as ever, you review through what we've done in this particular session, and also then look back to your chapter 7, and the next bit coming up tells you what we've been talking about. Also, apart from carry forward, the loss relief against total income. Now, I will quickly take you through that next time, but we've discussed it already in this session. You read through that for yourself. Don't look at example 2. We'll do that together, or you'll do it in class next time once we've had a discussion of this. But it would help if you just had a little look through there. It could make life a lot easier for you then when we move to our next session together.